Hello everybody, welcome to my channel. Today I will show you how to trade naked charts. So basically learning how to read momentum um, by having a bias and such, basically reading naked charts. So without further ado, we're gonna get started now. Alright, let me just load a fresh layout so I can show you. I trade gold, so mostly, so I'm gonna show you how to do it on gold, but this applies to basically everything. Okay, so as you can see, I have very like simple charts. I have indicators that are based like just on giving session information. Those indicators don't like give me a decision. So now let me just delete every drawing, as you can see. So this is a naked chart, all right? How do we trade this? It's very simple. First of all, you need to learn how candles work. Basically, a lot of people, a lot of traders are gonna tell you that the more like dark candles, the or red candles, the more it's bearish, so the more it's going down. But that's actually the opposite. Markets move in a certain manner that the last move of every trend is almost always like a huge swing. Basically, wave traders will tell you that this is a fifth wave, but I just call this a liquidity grab, or like it's a capitulation of buyers. Let me show you an example of that. Basically, we have this, downtrend here. We have this downtrend just here, and as you can see, the last candle, the bottom of it, is a huge down candle, a huge push. All right, that grabs every buy side liquidity here. So how do we apply this in trading? It goes up like it goes the opposite way as well. As you can see, we have this huge uptrend. All right, market is going up, and this is how it ends. All right, markets basically never end like that. Okay, so basically, let's say you have an uptrend, it's never gonna end like that, going slowly and then reversing. It's gonna end by going up. Okay, we have a slowing momentum, then we have a final liquidity grab to grab all of the sell stops, and then we go down. um Inducement traders will call this power of three. Okay, wave traders will call this the fifth wave, and other traders might call this head and shoulder, but basically it's all the same thing. It's based on market value and having a fair value in the market, grabbing all the stops, all the sells before going down. That's just how the market works, and as long as you identify this final push, you can almost always catch reversals. And I believe that catching reversals is the most important thing in the market. A lot of traders are going to tell you that it's important to ride the trend, but I believe it's quite illogical. If you think about it, if everybody could just ride the trend, especially in Forex, everybody would be making money, but it's not that simple. Obviously, yeah, you could be buying on all those points right there. You could be buying, for example, here and here and here, but you could also be buying here and then you would have lost money. It's not as simple as, buy the trend line or follow the trend. You have to understand how markets move. They are pursued by liquidity. Now, how do we read this? Basically, on a naked chart, if you don't have any trend line, no supply and demand, nothing, how do we read momentum? For example, if you read this chart, the first thing you should notice is that we had a downtrend, then we had an, a small uptrend, which is a retracement of this downtrend. We went down, and now it looks like we're printing what other traders might call a flag. All right, but This is not necessarily meaning that it's going to go down. A lot of traders would be telling you, oh yeah, that's a bearish flag, it's going to go down like that, then it does a flag like that, and then it goes down again. A lot of traders would be telling you that, but it's not necessarily the case, especially if you're trading gold. um Basically, you have to understand that traders are made to be trapped, okay? The whole point of the market, the whole money making machine, is that you take money from other traders. So if it was that simple, everybody here sees that it's going down, then it going down would not be very logical, because then everybody would be making money, and if everybody makes money, then somebody's losing money, and it's not going to be the big banks, it's not going to be the market makers, it's going to be me, you, etc. So when you look at this, you have to think in a different manner. I don't see a flag here. I don't see a loss in momentum. I see here a final push, right? A huge like downswing, basically. Then I see it taking back momentum. Now buyers are stepping in more in the market, all right? Which means that since there's more buyers, it's gonna go push now, because basically markets move from one liquidity to another. Let's say this is liquidity, all right? This is like where a lot of orders are, and this is where a lot of orders are. You're always in a range, all right? Um, so then once the market, let me show you that. Once the market goes down, okay, and it grabs the liquidity here, it's gonna go and do something like that, okay? Like that, consolidate, then go down like that, print the last, liquidity grab, and then starting to go up. This is referred to as a fifth wave wick off, or even head and shoulders. You must have heard of something like that. But basically, when we reach that point, this is no longer considered a bearish flag. This is considered a reversal. But if we look closely, this is the same thing but on the opposite direction. We have our uptrend, all right, which is like the downtrend right here. We have the uptrend, then we consolidate here, all right, and basically we have this final push right here. Then we're pushing down. But once we reach a point where all liquidity has been grabbed, especially since if you look closely, we are relatively down in the market, right? It's relatively like cheap right now, which means the liquidity is way more on the upside than it is on the downside. So the probability of it going up is way more because there's more money up, simply put. All right. The market is going to go where the money is, right there. You had people short here, you had people short here, you had people short here, 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 etc., etc., etc. You can go all the way down. Here you had people short, here you had people short, basically. So there's a lot of liquidity right now. Now, how do we capitalize on that? How do we time the movement? It's very simple. All right. You don't have to. That's the beauty of trading. If you are right on the general bias, you're going to be making money. As long as you know the direction when you're buying is not important. Think about it like that. If you had an asset, all right, that was worth 10,000, if I tell you that I can sell it to you for 6,000 or 5,000 or 4,000 or 7,000, it's not going to make a big difference. You're going to take the deal anyway because you know you can make profit of it. And that's how you read basically naked charts. You have to understand this kind of cycle. All right. Markets always shift and reverse using this special pattern. Let me show you like that. Okay. You might see various variations. Let me show you, for example, other kinds of variations. You would have, for example, a huge swing down, then a little reversal like that, another huge swing down. Let me just show you that. And then it would start pushing back right away back up. Okay. This is a trap. Okay. When it starts pushing back up right away without like a final push and without like liquidity being taken, you have to look out for the higher time frame as well. You have to look out for the higher time frame because this might be a liquidity grab on like a higher time frame scale. But nonetheless, when the market like goes and pushes right back up, this is what it does. When it pushes right back up, you know that this is probably a trap. So when it goes down like that and then goes back up, breaks that first like swing down, then you know that at some point it's gonna come back and take that liquidity, or at least reach what we call the base. Okay, the base is the first candle that pushes up. Usually, other traders are gonna call that a order block. Let me show you an example right there. For example, here. Okay, this is a very good example of base. All right, you have that wick that acts as a very, very, very strong resistance. Okay, when market reaches that zone, you know that it's very probable to hit and go back up. Now, this is a perfect example of it. You have an uptrend, all right? You have an uptrend and then it goes down. It didn't grab any liquidity. It stayed like it didn't take anything besides maybe this low, but it didn't go down, which is where the main liquidity is. For example, here, it didn't go down here, or down here, for example. It really just didn't take much liquidity. So at some point it's gonna come back and hit that zone again, either break it or at least reach it. So when you're up here and you see this kind of movement again, okay, push, then we consolidate, okay, we consolidate as you can see, and then another push right above the high, and then another push down. Then you know that it's very, very, very not very likely, it's almost certain actually that it's going to go down from there. Once you have that power of three, so that you know up push consolidation, then liquidity grab to the top, you're almost certain that it's going to start to go down. And it went down, obviously quite slowly because gold is very slow. But then you have this as a target. So the moment you see this, you could have shorted here and made money as long as you put your stop loss above the high. And then low, I know a lot of people are screaming right now at this risk to reward ratio, but it's not important. As long as you make money in the market, as long as you are profitable, that's what matters. Or you could have put something, Fibonacci for example, from here to here, and then trade it off the golden zone, for example. Or used like the half candle technique, or there's an order block as well. Like, the important is just having the bias. The entry is not as important as people think, as long as you have the bias. And when we are at that point, okay, in the market, we have our bias. We know that, okay, it's going up, yeah. Then we reach that point, huge swing. Now a lot of people are buying, right? Then what do banks and market makers do? They fuck you. It's as simple as that. Once you see this, either you can enter on right on the close of this candle, which is what I do. You put your stop loss be above the high, or you can wait for a retracement at Fibonacci, like we said, or whatever. You can do what you want, but at the end, it doesn't matter. All right, as long as you have the right direction, as long as you're not buying here, because a lot of people, they're gonna tell you what, follow the trend. So they buy here thinking this is a support, all right, which a lot of traders would have done. And look what happens. It goes up, oh yeah, my support works, whatever. You're waiting for a break. Then you see it's going kind of slowly. Yeah. Then you see it, okay, yeah, it's coming back. Yeah, right. And then you just get absolutely smashed. That's what happens because the bias is not good. If your bias is not good, you can't make money. So that's how it's important to be able to read charts naked. All right. Don't be scared to trade against the trend. That's what a lot of traders mistake. They say trade the trend, but I bet you ever thought that that's quite illogical, because if everybody was trading the trend, then nobody would be losing money. But people lose money in the market. So once you reach that point, okay, let me just show back the charts. When you're there, okay, so it went down, whatever, you reach that strong zone, okay. So now we are bouncing off of it. Now what we're waiting basically in the market is for something like this, okay. We go up, now we got like our big momentum, then there's so much liquidity to grab here. Either we go down here below that previous low, or we're just gonna go like below this low right here. We're just gonna go below this low. It's almost the same point, but that's, that's not so important. Now, once we do that and we have our confirmation, which is again like the liquidity grab, then a strong move upwards, which shows like a shift in momentum. Now we are for certain sure that it's gonna go up from there, and we can target the liquidity that was left behind on the other trends. And this is like on a very, very higher time frame, you know reach those liquidities that we already highlighted. But obviously it's not as simple as that. It's not going to go as smooth as this, but that's the general idea. You have to be looking for this kind of pattern. People call it a wick off, and a lot of people are over complicating it. But it's simple. You need a base consolidation, right? Then a spring to the direction of the trend, then pull back. Automatically, when you see this, it's confirmation that it's going to go down. That's how you read naked charts. That's how you get your bias. And remember, guys, your bias is the most important thing. Um, so, like I said, don't be scared of trading the trend. Don't be scared. Don't be scared of trading against the trend. Keep an eye open and always be like ready to change your mind if you see something. It's very important to not be blind on the charts, not be like biased by your emotions or what you believe is going to happen. The market isn't like it's a infinite source of opportunities. So as long as you are open to those opportunities, you're going to be making money. Thank you very much for watching this video, and I see you in the next one.